Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing passive mutual funds and whether some of the more evolved, newer passive products, which let you invest in, say, certain themes, certain sectors, or certain complex strategies, whether they are worth your while. And of course, we're in conversation with Anand Vardarajan and Vishal Jain. Anand is from Tata AMC, and Vishal, of course, the CEO at Zerodha Fund House. So now, gentlemen, I want to talk about sectors and investing in sectors and themes. And here I always play the investor's self-appointed advocate, right? A lot of funds get launched when sectors are doing well. It's the nature of the market. There's excitement, so defense funds will get launched, or, railway and PSU funds will get launched. And many a times, we've seen that these launches are on the passive category. And that's when, at least, I get sometimes a little, uneasy, wondering whether people understand the risks involved well enough. Anand, what's your thought? Because if it's let's say a defense sector index or any other sectoral index, which is fairly narrow, and then within that it's a passive product, so you're just hugging the underlying index, isn't that very concentrated risk?
Yeah, you're right. I think one is there are fads that you have to avoid, and if it's the most popular thing and everyone and their uncles are talking about it, then you know that this is getting a little too much, overheated, and best to kind of avoid. I think I will distinguish this into two parts. One is whether the story is cyclical or structural. Take the case of, there have been themes like, say for instance, India over the last couple of years, tourism as a theme has kind of evolved, or capital markets, for instance, like pre-COVID, I think there were about 4 or 5 crore demat accounts. Post-COVID, now we have roughly 20 crore demat accounts, and 15 crore demat accounts have been added post-COVID. So tough to call it cyclical. So if it's a structural theme where we see financialization of savings, we think capital markets group booming and so on, then possibly all the players in the ecosystem, which could be, say, brokers, RTAs, asset managers, wealth managers, and so on, could benefit. So an index of that sort could potentially do well over a period of time.
Okay.
If you were to look at something where, like you mentioned, if the sector is very narrow, very few stocks, hardly even churn has any kind of space, because you just keep rotating in and out of the same 12, 15 stocks, that becomes a little tricky to manage. And the risks obviously then become much higher. So you have to really see whether the sector theme is tailwinded, whether those tailwinds are already there in play, and if that is the case, then perhaps it's not a bad idea to look at some of them favorably.
Okay, now let's ask both of you to wear the hat of advisor, which I know could be unfair because you guys are, product manufacturers. But Vishal, maybe give us your own example, or someone in the family, friends or family ask you to create a portfolio using maybe an all passive portfolio or a reasonable blend of active and passive. Just give us a broad composition. What would you go with? Small cap, large cap, sector, themes, etc., etc.
So I'd go for about, keeping in mind that I'm conservative in general. So I'd possibly look at about 40% large cap, maybe about 20% mid cap, about 10% small cap, 15% gold, and the rest in debt is something that I'd look at.
Now within that's the question. Will it be all through passives?
Yes, if I think that there is something which, I think that maybe might outperform, like you're saying, if there's some sector theme or some product like that, maybe max 10% of that portfolio I could allocate towards, one of those, I would say, flavors of the month.
Okay, all right. But all fully, passive investing portfolio there, cutting across, of course, some of the segments and asset classes that you spoke about. Anand, same question to you. What's the perfect blend portfolio?
I don't know perfect. It's horses for courses. That's why it's called personal finance. It's
yes.
Not, it's
personally for you. Let me
correct.
ask you.
But I would think that maybe 80-20, 80 in favor of active, 20% passive.
Okay.
And within that, if I were to split, I have a 40-30-20-10 rule, which is 40% large caps, 30% could be mid and small caps, 20% could be some of these kind of sectoral bets that that I feel convinced about, and maybe 10% is something which I would just keep aside for any kind of opportunity or just some cushion.
Okay, and the 20% that would be passives through passive funds. That would be what kind of passive? Will it be all large cap indices based? What are the other things that you feel very convinced about?
See, some of these sectoral bets is what you know. I could be a wrong investor because I could be slightly aggressive. It could be different for different set of investors, but I would have a slightly more aggressive tilt to some of these sectors or themes, depending on what I feel constructive about at that point in time.
Okay, all right. And what we've not discussed, obviously, viewers, you need to go back and discuss this with your own individual advisors, take your own informed calls, and then decide. First of all, what's your asset allocation? And then within that asset class, do you want to do it through the active route or the passive route? But one of the things that we haven't discussed, one of the greatest advantages of passive investing, that is, it's such low cost, a fraction of what active investing would cost us. Just a quick sense on whether the costs are already at rock bottom, or Vishal, would they head even lower? How do they compare with the global average?
If you look at the large cap ETFs now in the market, most of them are at about 4 or 5 bips, which is comparable to international markets as well. So I don't think in the large cap space, you can go down any further. At this point of time, mid caps and small caps and the other products are, products which are still gaining economies of scale. And, once the industry or those products get economies of scale, I mean, slowly costs will start coming down in those as well.
Okay. Your final tips and advice, I mean, the checklist, important checklist to keep in mind before you go in for passive investing.
I've said all that, Surabhi. Asset allocation, look at a core and satellite kind of an approach, and keep investing at regular intervals in the market.
And when you choose within passives, are there any metrics to track or parameters that you should be aware of?
So if it's if you're looking at index funds, then definitely look at the tracking error and the expense ratios. If you're looking at ETFs, then definitely do look at the liquidity as well as an additional criteria.
Okay. And Anand, your final piece of advice to our viewers?
First, don't fall for fads. Be very clear whether you're getting into something which you understand, first of all. Second, this active-passive debate is kind of overdone. I think you should have a blend of both, because each of these work differently at different points in time. 3, cost to customer that I look at is basically your tracking error, tracking difference, plus your cost. I think overall you should really look at it in toto and see whether it makes sense, because TETD becomes an important thing to look at when you're investing in passives. So please pay attention to that. Yep.
Okay. All right. I think that's a very helpful advice, and it's a good mini classroom on passive investing for those who may not have started so far. Thank you so much, both of you, for joining in and giving us important context when it comes to passive funds. Thanks for joining in.
Thank you, sir.
Thank you.
Well, with that, we're out of time on this edition of Let's Talk Money. Thank you so much for being with us. Keep sending us your feedback, comments, and queries. We'll see you again next week with another theme.
Let's Talk Money